Welcome back to the Deep Dive. Today is Friday, February 6, 2026.
And the dust is definitely not settling yet.
Not even close. I think the market is still trying to figure out what just happened.
I think we all are.
Absolutely. But before we get into the absolute monster of a news story we woke up to, I have a recommendation for you. If you want to get a real handle on the market's mood, to track the total market temperature with all this volatility, you should search for and download the iOS app Buffett Indicator from the Apple App Store.
It's a great tool. It really helps you zoom out and see the bigger picture, without getting caught up in the minute-by-minute panic.
Exactly. It cuts through the noise. Okay, a little bit of housekeeping before we jump in.
The important stuff.
The important stuff. Full deep value research reports for everything we talk about can be found in the description links. All our analysis is based on publicly available sources, and of course, it might be subject to different interpretations.
And this is all for educational purposes, so please, it is not investment advice. You have to do your own due diligence before making any investment decisions.
Right. And if you want to listen to our full, unabridged deep dive on this or get access to more advanced content, come join the Deep Value Club membership or subscribe to us over at deepvalues.ai.
And don't forget to like the video. It helps a lot.
Much appreciated. Okay. Can we talk about the elephant in the room now?
The $2.4 trillion elephant.
That's the one. Amazon. Ticker AMZN. They dropped their Q4 2025 earnings yesterday, and reading this report, it feels less like a financial statement and more like a blueprint for world domination.
It was a headline grabber, for sure.
Yeah.
But maybe not for the reasons people thought it would be.
Well, the top line looks good, revenue is up, everything seems fine there, but the real story, the thing that has Wall Street completely spinning, is the spending.
Oh, spending.
They are planning to spend $200 billion in 2026 on capital expenditures, CapEx.
$200 billion. It's a number that's so big, it's almost meaningless. To put it in perspective for you, that's roughly the entire GDP of Greece.
A whole country.
Or New Zealand. Amazon is planning to spend the economic output of a developed nation on infrastructure in a single year.
It's just staggering. So our mission today isn't just to look at the stock chart. We really need to unpack the deep value analysis here. The central question we're wrestling with is this. Is Amazon turning into a giant capital trap, just burning cash to run in place?
Or are they actually building the literal infrastructure of the future? Is this the most brilliant long-term bet in corporate history?
It's one or the other. And to figure that out, we're going to run it through a Buffett-style checklist and a discounted cash flow analysis to see if this company is actually worth its $2.4 trillion price tag.
Let's do it.
Okay, let's start with the Q4 2025 numbers that just dropped. Break them down for us.
So on the surface, if you just read the headlines, it was a really strong quarter. Net sales jumped 14% year over year.
To $213.4 billion.
In 3 months.
Yeah.
It's just an unbelievable amount of stuff being sold.
That is a lot of brown cardboard boxes showing up on porches.
It is. And the growth wasn't just, domestic. North America was up 10%, which is solid for a market that big. But international grew 12%.
And even more without currency effects, right?
Right. If you strip out the currency fluctuations, international was actually up 17%. So the retail engine is firing on all cylinders. But the real star, like it's been for a decade, was the cloud.
AWS and Amazon Web Services?
Yeah, its revenue surged 24% to $35.6 billion. That's the fastest growth rate they've put up in 13 quarters. So anyone who was saying the cloud business was slowing down, well, these numbers say otherwise.
Okay, so sales are great. Cloud is accelerating again. But here's the whoa moment for me. This is the part of the report that I think really spooked the market. Operating income hit $25 billion for the quarter. So on paper, they're just printing money. But then I scrolled down to free cash flow, and it didn't just dip. It fell off a cliff.
Plummeted is the word.
It went from around $38 billion a year ago, TTM, to just $11.2 billion.
Yeah.
Help me understand that. How do you make $25 billion in profit in one quarter, but your annual cash flow basically evaporates?
That is the $200 billion question, isn't it?
Yeah.
It all comes down to one line item, CapEx, capital expenditures. They increased their spending by a massive $50.7 billion this past year.
A $50 billion increase. What are they buying? Is this just more warehouses, more blue vans?
Some of it, sure. But the vast majority is going into two places, AI chips and the data centers to house them. And CEO Andy Jassy is being very clear about this. He's guiding for even more next year. That's where we get that $200 billion figure.
And the market's reaction was not great. I saw the stock swing wildly after hours, down anywhere from 2.5% to 10%.
People were scared. And honestly, maybe they should be. An investor looks at that free cash flow number dropping from $38 billion to $11, and they get these flashbacks.
To what? The dot-com bust.
Specifically, the telecom build-out in the late 90s, the fiber optic bubble. All these companies spent billions and billions laying fiber optic cable across the globe that nobody needed yet.
Right, hoping demand would eventually catch up.
And it didn't, not fast enough. It became a classic capital trap. The fear is that Amazon has to spend this money just to keep up with Microsoft and Google in the AI arms race. And if you have to spend $200 billion a year just to defend your market share, that's a really, really bad business.
It's like you're on a treadmill and the speed just keeps getting cranked up higher and higher, and you have to run faster just to stay in the same place.
That's the bear case in a nutshell.
But Amazon isn't just an online store anymore, is it? I mean, looking at the 2025 revenue mix, the actual online stores selling stuff, it's only about 38% of their revenue now.
It's the minority share, and it's by far the lowest margin part of their business.
Exactly. Then you've got third-party services at 24%, AWS at 18%, but AWS is where all the profit comes from, and advertising is now 10% of the business, which is fascinating.
And that mix is precisely why the capital trap argument might be completely wrong. There's a powerful counter thesis here, what we call the double monetization thesis.
Okay, double monetization. Walk me through that.
So think about what that $200 billion is buying. They're buying their own custom AI chips, Trainium 2, Inferentia, and building these enormous data centers. Benefit number one is internal.
Okay.
They use all that computing power to make their own operations more efficient. They run the robots in the warehouses, they optimize delivery routes, they serve hyper-targeted ads. It saves them a ton of money.
So the spending on AI makes the low-margin retail business a little bit less low-margin?
Precisely. But here's the genius part, benefit number two. They then turn around and rent that exact same infrastructure out to other companies through AWS.
So they build a supercomputer for themselves, use it to run their store, and then charge Netflix and everyone else to use the leftover capacity.
It's like building a massive house for yourself, living in it, and then renting out all the extra rooms to the entire neighborhood. They get paid twice for the same asset.
That creates a pretty powerful moat, I'd imagine.
A huge one.
Yeah.
And it leads to this concept called data gravity.
Data gravity. Sounds heavy.
It is, if you're a customer. Once a company moves all of its data into AWS, maybe to use their Bedrock AI platform, that data becomes incredibly heavy. It is incredibly difficult, expensive, and risky to move it somewhere else.
The Hotel California of the cloud, you can check out anytime you like, but your data can never leave.
That's a pretty good way of putting it. The switching costs are astronomically high, so that $200 billion in spending isn't just maintenance you see. It's them digging the moat deeper and wider around the castle.
And speaking of moats, we can't ignore the physical one. I saw a stat that just blew my mind. 13 billion items delivered same day or next day in 2025.
13 billion. The scale is just incomprehensible. And fulfillment costs are over 40% of online sales. Think about that. For every dollar of stuff you buy, 40 cents goes just to the logistics of moving it.
No one else can afford to build that.
No one. Even if a competitor had the money, where would you even start? Amazon has effectively built a private logistics infrastructure that rivals the Postal Service. The cost to compete is prohibitive.
Okay, but let's take a breath. It can't all be good news. There have to be risks here. You don't spend this kind of money and pivot a company this large without some major headaches.
Oh, plenty of headaches, both short-term and long-term structural ones.
Let's start with the short term. I'm hearing a lot about consumer downtrading. What does that mean?
It's a fancy way of saying people are feeling the pinch from inflation and interest rates, so they're buying cheaper stuff. Instead of the name brand product, you're buying the generic Amazon Basics version.
Which is fine for Amazon. They still make a sale, but the margins are lower, right?
Exactly. It squeezes their retail profitability.
Yeah.
And you could see them reacting to that pressure with cost cuts. They just cut 14,000 corporate jobs.
I saw that. They took a $730 million severance charge in Q4.
Yeah. And that highlights a big execution risk. They're trying to manage this incredible complex global machine and cut costs at the same time they're trying to build the most advanced AI platform in history. That is a very difficult balancing act.
And then there's the big, scary long-term risk. The government. The FTC lawsuit.
The elephant in the room. filed back in late 2023, still ongoing. The FTC is arguing that Amazon is an illegal monopoly. The real risk here isn't a fine. I mean, they can pay any fine. The risk is a forced breakup.
What would that even look like, forcing them to spin off AWS?
That's the nuclear option. And if that happened, it would destroy the entire investment thesis we just talked about. That double monetization flywheel. It just stops working.
And at the same time, they've got serious competition.
Absolutely. AWS is the leader, but its market share actually dipped a bit, down to around 29%. Microsoft Azure and Google Cloud are growing faster and are very, very hungry.
So they're spending $200 billion to defend a castle that's being attacked by regulators on one side and Microsoft on the other.
Correct. And that leads to the biggest risk of all, which is the AI bet itself. What if they build all this capacity and the massive demand they're expecting doesn't materialize as quickly as they think?
They'd be stuck with warehouses full of expensive, depreciating chips.
Exactly. It could turn into a massive, massive write-down.
All right, let's pivot. This is what we're here for. The deep value analysis. Let's run the Buffett checklist. We know Berkshire Hathaway owns some Amazon, but the real question is, would a value investor buy it today?
At this price. Okay, let's go through it. First, PE ratio, price to earnings.
It's trading at around 32 times 2025 earnings.
Yeah, Buffett likes to see that under 15, maybe 20 for a world-class business. 32 is way too rich for his blood. That's a clear fail.
Okay. What about price to book value?
Even worse. It's somewhere between 6.7 and 8.6 times book. I mean, a classic value guy gets nervous over 1.5 times book. So, another hard fail.
Free cash flow yield. I'm guessing this one isn't going to pass either.
It's barely positive because of all that spending we talked about. There is essentially no yield. So, fail.
Ouch. 3 strikes. This isn't looking like a classic value play at all.
Not on the price metrics, no. But now we get to the quality metrics. Moat and safety.
And how does that look?
This is a definitive pass. Their interest coverage ratio is 42. That means they earn $42 for every $1 of interest they owe. They can easily pay their debts. The company is a financial fortress.
Okay. And management.
I'd give that a pass, too. Bezos is still executive chair. He owns about 9%. He's still got skin in the game. And Andy Jassy's compensation is heavily weighted to stock. They're aligned with shareholders.
So it fails on every valuation metric, but passes on every quality metric.
Which has been the story of Amazon for 20 years. It has never, ever looked cheap. But this is where the modern value analysis gets really interesting and really complicated.
This is the part where the math gets fuzzy.
Very fuzzy. Because we have 2 different discounted cash flow models in our research from 2 different sources. And they come to wildly different conclusions.
I saw this. It's confusing. One analysis says the stock is worth maybe $34 a share. The other says it's worth $290. The stock is at $230 right now. How can 2 DCF models be that far apart?
It all boils down to how you treat that $200 billion in CapEx. It is the only thing that matters.
Okay, explain.
Source number 1 takes a very strict by-the-book accounting view. They say, look, the free cash flow is $11.2 billion. That's the number, period. If you project that number growing at a reasonable, say, 15% a year, the math tells you the company is worth about $34 a share.
Which would mean it is one of the most overvalued stocks in history right now.
Bubble of a lifetime territory. That's the capital trap view. But source number 2 makes a critical adjustment. They use a concept called owner earnings.
Owner earnings. Warren Buffett talks about this.
Right. And they argue that most of that CapEx isn't maintenance spending, the cost of keeping the lights on. It's growth spending. It's discretionary.
So they're saying Amazon doesn't have to spend it. They choose to spend it to grow bigger.
Exactly. And if it's a choice, then for valuation purposes, you can add most of it back to the cash flow. You say, well, they could have just kept that money if they wanted to.
And if you do that math,
the intrinsic value jumps to roughly $290 a share.
Making it undervalued.
Right. So you see the entire investment case, whether it's worth $34 or $290, hinges on one single judgment call. Is that spending required or is it optional?
That's fascinating. It's a perfect example of how valuation is as much an art as it is a science.
It really is. But here's the crucial takeaway for you listening at home. To justify today's price of $230, using the strict accounting method, you have to believe that Amazon can grow its free cash flow by 40 to 50% per year for the next 10 years.
50% a year for a decade. For a company this size, that seems nearly impossible.
It is pricing in absolute perfection. The market is betting that this AI gamble pays off bigger than anyone can imagine. Any slip up, and the stock has a long, long way to fall.
So what are the big fish doing? What's the smart money saying?
It's mixed, which reflects that exact dilemma. Warren Buffett is still holding his stake, worth about $2.3 billion. He sold a little bit in 2023, but he's mostly standing pat.
But then you've got Michael Burry from The Big Short.
He's on the other side of the trade. He sold his entire Amazon position, and he took the money and bought Alibaba instead.
A classic value move. Selling the expensive U.S. tech giant for the beaten-down Chinese one with a low PE.
He's clearly in the it's a capital trap and way too expensive camp.
What about the board of directors? Any activism or drama there?
Rock solid, actually. All 12 members were reelected. And what's really interesting is that in 2025, shareholders voted down all of the ESG proposals.
Things like client reports, union audits.
That stuff. All of it.
Right.
The big institutional shareholders like Vanguard and BlackRock basically sided with management and said, forget the distractions, just focus on the business and the AI build-out.
Interesting. And what about buybacks? Are they buying back their own stock?
They have a $10 billion authorization on the books, but they're barely using it. They say they'll use it opportunistically.
Which is code for, we think spending money on AI chips gives us a better return right now.
Exactly. If management thought their own stock was a screaming bargain at $230, they'd be buying it backhand over fist. The fact they aren't tells you a lot. They'd rather make the big bet on the future.
Okay, let's try to wrap this all up. It's a huge, complex story. What's the final verdict?
Amazon had a strong Q4. The sales numbers are great. But they are making a historic pivot to become an infrastructure-as-a-service company backed by a $200 billion spending plan.
It really is a bet the company kind of moment.
It is. So the value verdict is this. It fails every single test on a strict, traditional Buffett checklist for price. It is not a safe, classic value stock, but it passes with flying colors on quality, on its moat, and on its management.
So it's a high-risk, high-reward bet on the future of AI. You're not buying a retailer anymore. You're buying an AI infrastructure play.
Exactly. You're betting that Andy Jassy is right and that the nature of spending has changed.
Before we sign off, I have one last thought I want to leave with you. We talked about moats and the cost to compete. If Amazon is spending $200 billion just to stay ahead in AI, what does that mean for every other company in the world that can't afford to spend that?
That is the truly scary question. The price of admission to this game is now hundreds of billions of dollars.
So are we looking at a future where Amazon isn't just another tech company, but they're actually the landlord of the internet? If you can't build your own AI factory, you have to rent space in theirs.
And landlords, eventually, always raise the rent.
Something to think about. Thanks for joining us on this deep dive.
It was a great conversation.
And remember, if you want to put these huge market moves in context, search for and download the iOS app Buffett Indicator from the Apple App Store.
It really does help.
As always, full deep value research reports are in the description. This is all for educational purposes, so please do your own homework. If you want the full, uncut experience, join the Deep Value Club or subscribe at deepvalues.ai. And don't forget to like the video.
We'll see you next time.
See you next time.